Okay, well, good morning once again, and good Friday to you all. I hope everyone is doing well out there and staying safe and healthy. Welcome to the commercial real estate courses. What happened in the spring of this year was we were hosting the commercial real estate courses in person. They were being held between here, the Richmond Hill office, and the Thornhill office. And we got four sessions in. There's 10 sessions in total. We've got four sessions in person, and those four sessions were not recorded or videoed at all. They went to about the middle of March, and then, as we all know what happened in the middle of March, the world basically shut down to a large extent, in Ontario anyways. And we continued on with the next six courses with being videoed via Zoom, just like we're doing this course here. And so out of the total 10 courses that there are, 10 sessions that there are, just about six are available on our Century 21 Heritage Group YouTube channel. These four that we're going to do this week and the next 4 Fridays are not as yet. And I believe the strategy that we're taking here is we're going to do these four online, and then the next six you can watch yourself already on the YouTube training channel. I think session 9 needs to be redone or something. I have to talk to Joseph about it, but before anybody will get there, I'll have that done. So we will talk about that a little bit further when it comes to homework. But we are going to do these first 4 sessions online, and then we can have a discussion on how to handle the next 6 from there. So welcome, commercial real estate. The way I like to run my Zoom meetings is really quite simple. I like to try to answer chat questions. There's a chat button for you to use. I try to answer chat questions as they come along. I do the best I can. If you know how to unmute and mute yourself, you're more than welcome to say, hey, John, and interrupt me if you have any questions. One of the great parts about Zoom meetings is that everybody can join these from home, and it's a very convenient thing to do. One of the more difficult things about Zoom meetings is to try to have some kind of meaningful interaction and conversation about this kind of stuff, and about the subject matter, I guess, is a better way to put it. And so don't hesitate to unmute yourself or send me a chat. More than happy to try to engage in conversations in this, or else I just kind of drone on, and it's not very exciting for anybody. And so please do not be shy. Please answer your questions, or ask your questions via chat, or unmute yourself and then ask the question. If you unmute yourself and we answer your question, then I ask you please to remember to mute yourself so that we don't have any background noise happening. So welcome to the commercial real estate course. I generally try to ask if there's any questions. I try my best to try to engage everybody. So please don't be shy. Try to ask anything that you want. I'll do the best to answer you. So here we go. In commercial real estate, and this is actually true for just about any decision that anybody makes, it's called an opportunity cost. An opportunity cost is an opportunity cost refers to a benefit that a person could have received but gave up to take another course of action. Nothing could be truer in commercial real estate. Why? Because in commercial real estate, in general terms, the decision is made because of money. And so a typical example of that would be, a buyer's got $1 million, and he can invest that money safely at a 4% interest rate, okay, with a Canada savings bond, or not a Canada savings bond, but a government bond of some sort. Or should he invest in something that has a 6% return, but there's risk involved? So is he going to give up the extra 2% for the risk to get the 4% guaranteed income, or is he willing to take that risk? That's called opportunity cost. You do this on a regular basis. All of us do this on a regular basis when we go shopping. We look at the bananas in a grocery store that are on for 49 cents a pound? Or should we buy the natural bananas, oh my goodness, the name just went right out of my head. The, you know what I'm trying to say here, the natural bananas. The what?
Organic.
Thank you, organic. It went right out of my head there. Or the organic bananas for 79 cents a pound. Which course of action are you going to take? The benefit of the organic banana is obviously health-wise, instead of getting something that's sprayed with all sorts of chemicals. Or are you going to save the 30 cents a pound? That is an opportunity cost. Sometimes what happens in commercial real estate is that you will work with a buyer or a tenant, for sure. And all of a sudden, the buyer is coming along and he's coming along and it's going really, really well. The deal's working out really, really well. And all of a sudden the buyer disappears. Well, obviously it could go to another real estate agent, but more often than not, what happens is that the buyer has looked at the opportunity cost and has gone, wait a second, even though this looks really, really, really good, I can do something better with my money. And that is opportunity cost. Okay, you have to know about opportunity cost in commercial real estate because it influences a buyer's decision. In residential real estate, it's this: I love this house. I love it. I love it. I love it. I love it. I want it. I want it. I want it. And they buy it. I always like to talk about examples. Yesterday here in Richmond Hill, an agent had 24 offers on a house. I think it probably oversold by about $70,000. Gee whiz, there's the love factor involved there, right? They're overpaying for a house. Oh my goodness. In commercial real estate, that basically does not happen. It's simple as that, because at some point the buyer's going to say, wait a second, I can do this with my money instead. I can do that with my money instead. Why should I take the risk of going on with this? It's called opportunity cost. Does anybody have any questions about opportunity cost?
Hi, John. Good morning. It's Andy Hurdle.
Hi, Andy.
Would you say then the difference between the two is the opportunity cost, the difference between the safe bet versus the risk? Is that what the opportunity is?
Yeah, basically. In the case of the banana, it's a good question. In the case of the banana, it's the difference in health, right? In the case of a residential real estate, it could be location. It's just the difference between two things. But when it comes down to commercial, it's basically money. What is the risk and what's the money involved? What is the percentage in risk and money involved? Good question.
Thanks, John.
You're welcome. So here's an example. You're an investor, okay? You have these two choices of houses to buy. The one on the right that's not finished is less money. It doesn't matter how much less money, but it's obviously not. One on the left is finished. So in terms of opportunity cost, anybody want to put out what they want, which one they would buy? What do you think? Anybody? Andy, which one would you buy, Andy?
I think it depends on the timing. Like the one on the left, you could probably turn it over quick, whereas the one on the right might take an additional time. So what's the value of your time involved?
There's also another thing too, John.
Sure.
There's a possibility that the one that's not finished is being finished by a builder who still owes taxes and HST on it. There might be a lot of hidden costs, and that it's not at the occupancy level that the one on the left is. So there might be additional hidden costs. So like the previous speaker said, it's about timing.
It certainly is. And so there's a decision for a commercial buyer who wants to flip a house here. What's the opportunity cost? The opportunity cost is timing. The opportunity cost is the time value of money, is what it's called. And so is it better to spend, let's say, $500,000 on the one on the right or $600,000 on the one on the left? Which one's going to have a higher return in the end? Well, this is the thing that we don't know because we don't know if the buyer is a contractor. Maybe they can finish the house on the right really quickly and get it all done and sell it really, really fast, right? Whereas on the one on the left, maybe it's a non-contractor who wants to buy it and can just flip it really, really simply, right? But it is a question of which one is the best one for the buyer. And when it comes to real estate, I try to teach all new agents that come in, and this is a great hint for all of you, is let the buyer decide. Don't you decide for the buyer. You're making a mistake, all right? Let the buyer decide what they want to do. The worst thing you can do is to talk a buyer into something that they don't want. Then they hate you because then they have buyer remorse after it's closed, right? You really, really don't want to do that. Let the buyer decide. And in commercial real estate, as opposed to residential real estate, it is even more important. You're not going to be able to influence a particular buyer in commercial real estate as much as you possibly could in a residential setting, all right? And as I know one person on here has found out, I think I saw her name, has joined us, it is really, really hard in commercial real estate to find comparable properties. And so sometimes buyers just have to take a few extra steps to come to that decision, okay? So in real estate, we're going to jump right into this here. In real estate, in commercial real estate, the number one thing that you need as a commercial real estate agent, whether it's a buyer or a seller that you are representing, is you need their income statements for their business. All right. It is the most important piece of paper that you can possibly obtain for a buyer or get from a seller. A buyer wants to see income statements because they want to see how much money the business is making. A seller, you need the income statements to try to determine the value of the business that you're looking at. An income statement is a snapshot of a period of time. It's usually 1 year of a business financial health or lack of any financial health that they may have. It is a snapshot of what is going on in that business. Now, there are what's called financial statements, okay? Financial statements include an income statement and it includes what's called a balance sheet. We're not going to get into balance sheets. A balance sheet really just kind of outlines more the, I want to say more the assets and liabilities of the company, but those assets and liabilities of the company are generally taken care of on a completion date, and we don't really need to know that information. Though sometimes it can be helpful to have a balance sheet, but an income statement is really, really, really what you are looking for in a financial statement, not the balance sheet, okay? An income statement, I can't stress enough how important it is to have an income statement for both buyers and sellers. And so what is an income statement? We're going to break it down. On an income statement, it's revenue, okay? It shows the revenue. The revenue equals sales. How much money is it making, okay? Sell a Coke for $1 means that your revenue is $1. Sell a tire for $90, your revenue is $90, okay? Your cost of goods sold is what have you paid for the goods sold? How much have you paid for a Coca-Cola? Now, here's where this gets interesting. And a commercial real estate agent walks into a seller's place and says to them, well, how much money do you make, okay? And the seller says, $1 million. Well, that's fantastic, $1 million. Wow, your business is doing awesome. Well, what is that $1 million anyways? Is that $1 million revenue? Well, that's great. That's a useless number, basically, if it's revenue. I mean, it's great to have the revenue, right? It's great to have $1 million in revenue. But what are your costs of doing business? And the first item on the list is the costs of goods sold. So your revenue, you might have sold $1 million worth of Coca-Cola, right? But what are the costs of goods sold for that? Okay. and that is gross profit. Okay, so revenue minus costs of goods sold is gross profit. So now you're talking to Mr. Seller, and Mr. Seller, how much money are you making in this business? I make $1 million. Well, is that revenue? Yeah, that's revenue. Oh, well, but how much money did you make? Oh, I made $500,000. Really, $500,000? That is absolutely tremendous. Yeah, I sold $1 million worth of Coca-Cola, and it only cost me $500,000 to buy that Coca-Cola. Well, actually, that's gross profit. That is not the number that we are looking for. And you have to do this kind of sleuth work to figure out what is this company actually making in terms of money. And it's not revenue. That's useless. Gross profit, it's helpful to figure this out, and you'll see why it's helpful, but it's not the number that we are looking for either. The number that we are looking for is net operating income, NOI. It is the gross profit produced by a business less all other expenses: rent, heat, insurance, repairs, legal fees, property taxes, cleaning. Everything else in operating expenses is NOI. And without net operating income, you cannot determine the value of a business. I'm talking about businesses here, not necessarily property, but I'm talking about business here. So when a restaurant is trying to sell their business, what is that restaurant's net operating income is the number that you require. It is not the gross revenue. It is not the gross profit. It is NOI that you need. Without NOI, you are up the creek. Net operating income is what you need. And net operating income is shown to you on the income statement. All right, not the balance sheet. And it's part of a financial statement that a seller should have. Okay, net operating income. Does anybody have any questions about where we are so far in this? We're going to go deeper into NOI, and we're going to talk about cash business in a few minutes. But does anybody have any questions? Does everybody get the difference between revenue, gross profit, and net operating income? It's just the basics of a commercial real estate transaction. Any questions at all? Geez, Tina, they're letting me off easy today. So we'll see. So net operating income. After net operating income is taxable income. Okay, taxable income is net operating income less depreciation and interest expense. All right, that is a number that you don't want either, because the client might say to you, oh, my taxable income last year was $25,000. Well, that really doesn't help, because there's depreciation in there, and you can have interest expenses in there. It gets a little more complicated than that, than taxable income, because sometimes depreciation is put into the income statement. Sometimes interest expenses are put into the income statement as well. But most of the time they are not. But taxable income is also a useless number to you. So you need to really dig. When you're just having a conversation with your seller, you need to find out what net operating income is. You got to make sure that whatever number they blurt out to you when you finally ask the big question, how much money does this business make? You have to make sure that you're talking about net operating income. So we're going to have a quick talk about depreciation. Depreciation is a method used to value assets in the business that are getting older. Okay, depreciation amounts, the percentage amount, is set by the government of Ontario. There's quite a long list of different depreciations that you can get. Okay, for a building, it's 4%. For equipment, appliances, furniture, it's 20%. There's a whole long raft of different depreciations that you can get for a car. It's different. I forget what it is for a car. If you're using it in real estate for 90% of business for real estate, you can write off your car for depreciation, that kind of thing. We don't really have to know what the depreciation rates are. We have to recognize that there is depreciation in an income statement. Okay, and we're going to get to that in half a second. I'm just jumping ahead a little bit here. And we also interest expense. Sometimes some accountants can put interest expenses into the income statement. Sometimes they take it away after the net operating income. So you have to be aware of these, okay? You have to be aware of depreciation and interest expense and where an accountant has put them into the income statement, okay? Interest expense is the amount of interest paid on qualifying interest payments that are tax deductible. For example, a business purchases equipment and borrows money to do so. The interest paid on that money borrowed is a deduction, and that deduction can show up either before or after net operating income, and it would be your job to figure out where it is, okay, because it makes a big difference to the net operating income. Both interest deductions and depreciation sometimes are before net operating income, and sometimes they are after net operating income. And you have to recognize that in an income statement. Okay, so here we go. So here's the examples. Gross profit. Revenue is $100,000. Cost of goods sold, $90,000. Your gross profit is $10,000. Okay. This number here is, you know, it's nice. It's nice to see, but it's kind of useless. This number is nice to see. This number is nice to see, but kind of useless. Net operating income is your gross profit minus your utilities, minus your marketing, minus your property taxes, minus salaries, minus other salaries. Maybe there's telephone in there. I've got utilities, I guess, telephone. Maybe there's car. Maybe there's travel expenses. Oh my goodness, there's all sorts of things that could be in here, okay? But what happens here is net NOI. Look at this. We started with 100,000 bucks. Great, hooray. Oh, $1. How much is this business worth? If it's a business, if it's $100,000, your business is worth a fair amount. If your business's net operating income is $1, it's not worth very much money, is it? Okay. Taxable income, you've got your net operating income minus depreciation minus interest. Taxable income equals 1 cent. Now, this is obviously made up numbers, but this is in general what an income statement would look like. All right. You would have your gross profit, you'd have your cost of goods sold, you'd have your gross profit, and then you'd have your revenue, your cost of goods sold, your gross profit, and then you'd have all your operating expenses. And I'm not sure who asked the question, but it could be other salaries and benefits could be in here. Could have all sorts of stuff in here. In real estate, you're all sole proprietors, right? When you buy gas for your car, when you're showing houses, you can have this as an expense, okay? You can have all sorts of things. Bought a new computer in here. Maybe that's under office supplies. What about pens and paper, right? All that kind of stuff can be in the expenses to determine your net operating income. Taxable income, then you're going to have this. So if the seller says to you, oh, my income is 1 cent, but what is that? You guys need to ask the question of what number are you showing me? What number are you telling me? And guess what? People always think they make more money than they actually do, just like everybody thinks their houses are worth more than they actually are. And you need to get the income statement from your seller, okay? Buyers want to see it. They want to see the proof of an income statement, okay? So here we go. Some examples. Gross profit is $10,000. We've come away from revenue. You have your utilities, marketing, property tax, management, salary, other salary. NOI equals $1. Okay, that's pretty straightforward. But what you will see sometimes, you will see an income statement in example number 2 that you have the same stuff, okay, that we had here in example number 1. Okay, but they've put the interest and depreciation into the income statement. Okay, now what you have to do then is you now have to take away the interest and the depreciation out of the income statement to come up with a real net operating income. And the real net operating income is $1, not 1 cent. You have to recognize when you are looking at an income statement, if it has these 2 items in here, you need to take it away. Why? Because you don't know what your buyer is going to do to finance this. This interest payment that the seller has here may not be the same as an interest payment that your buyer is going to use, okay, that the buyer needs to get. It might be higher, it might be lower. Maybe your buyer is paying cash for the business. Why does he care if he is paying cash that there's an interest expense? Depreciation is what the value of assets have been depreciated by. Back to the depreciation slide for a second. The depreciation slide is a method that is used to value assets in the business that are getting older. The government tells us that we recognize that there's a risk in doing business. We recognize that your assets are getting older as you are doing this business. And what people can do, what business owners can do, is they can depreciate the value of their assets. Okay, it's a beautiful thing because eventually it reduces your taxes. Okay, but because you're reducing, in this case here, you're reducing your net operating income down to 1 cent if you're including the interest here. But really, what happens when a business is sold is that depreciation amount could be different. And so, because what happens when you're buying a business is that part of this often is that you negotiate what the value of the assets are on the completion date. Now, what does that mean? This gets fun here. What happens is that, for example, is that a business owner has bought a machine for $1, okay? Over the length of time that they have run the business, they have depreciated that machine to a 50-cent value, okay? A buyer does not want to buy the business with a depreciated amount of that asset of 50 cents. Why? The buyer does not want to purchase that asset with a value of 50 cents because then they can only depreciate it down from 50 cents. Okay, so that the next time they depreciate it, maybe they can only get 5 cents out of it. What they would like to do is they want to buy that asset, the business with that asset at a value of, let's say, 75 cents. And it becomes a negotiation part of a sale of a business. The depreciated amount becomes a negotiated amount of the business, okay? The seller does not want to sell that asset for 75 cents. Why? The seller does not want to sell that asset for 75 cents because he has depreciated it to 50 cents. And if the seller sells it for 75 cents, he has to pay what's called recapture tax. The difference between the value of the asset and the depreciated amount is called recapture tax, which is a little bit perhaps complicated. But all I'm trying to do here is tell you that you need to take away the interest and depreciated amount, okay, out of an income statement so that you actually have a real net operating income. Let this become part of the negotiations, and the interest should definitely be taken out, because maybe your buyer's buying it in cash. He might take the net operating income and say, well, I have to have a mortgage as well, but my interest deduction is only 25 cents. We don't know that, right? If it's 25 cents, then the net operating income will be 75 cents, not $1, not 1 cent. Number 3. So here we have the same stuff as we had over number 1. Here's the other salary. Okay. What some people don't do, so here's we have our interest, here we have our depreciation. Again, you might want to take that out of there. But when you're doing a financial statement, management salary can be put in a couple of places. In example number 2, we have it in the income statement. In a financial statement, a management salary can be handled in 2 ways. It can be handled in the income statement, like I have in example number 2, or it can be handled into the balance sheet. And in the balance sheet, the management salary is done by way of a dividend to the management, okay? And especially that happens, it really does happen in a mom and pop in kind of corporation. 2 people are running a restaurant, it's run under a corporation, and they take a dividend out of their business, out of shares, instead of instead of a direct salary. Okay, so sometimes you are going to see an income statement without a management salary, and I know Gloria and I just went through this, didn't we, Gloria? And sometimes you'll see income, right? Sometimes a management salary is not in the income statement, okay? In which case, how is, in this case, the restaurant, how is mom and pop being paid? Okay, what is the real net operating income? You have to add the management salary back in to the income statement. If you have an income statement without a management salary, how's the people running this, if it's and specifically if it's a mom and pop shop, how are they paying themselves? Obviously, if they're paying themselves, you need to add that. You need to add that in to get your correct net operating income. Okay, so you have to be careful about in an income statement. You have to be careful about management salary, interest, and depreciation. And before Gloria asks me the question, Gloria, the stuff that we went over the last couple of days was definitely a little different than this, than what we're doing. I'm just trying to show the basics here, Gloria. We had to get into something a little deeper, okay? So you do have to be really, really aware of where's management salary, where's interest, and where is depreciation, okay? Be really aware of these things in an income statement. It's really, really important. And if you haven't had any experience with these things and you run into this kind of thing, that's why I'm here to help you work through this, to come up with what is really the whole idea behind the income statement is, how much money is this business making? What's going on here with this business? People try to hide stuff all the time. And we're going to talk about cash business in just a second again. But you really have to be aware of these major 3 things to come up with the real value of the business. Okay? Any questions about this? It's the key to figuring out the value of a business if you're on the seller side, and is the key information to be able to discern with a buyer what the real net operating income is. All right, the buyers want to see it. The buyers want to see the net operating income, of course, right? But guess who else wants to see the net operating income? The bank. The bank needs to see the net operating income. When they see a net operating income without a management salary in it, they're going to look at the buyer and they're going to say, are you running this business? Yes, I am. How are you going to get paid? Oh, well, they're going to add this back in. And what about this? And what about depreciation? What's going on there? Banks are going to take a net operating income and rip them apart to find out what the income statement says. They're going to rip it apart. They want to know what the net operating income is. Which one is the real number? Is it door number 1, door number 2, or door number 3? And it gets more complicated than this. I can honestly say that. I'm trying to show you the basics here. But mortgage companies do not lend. I can tell you right now, mortgage companies do not lend on a business unless they have a net operating income that can support the mortgage. Okay? So it's important for the buyer, it's important for the bank. All right? And it's also important for the seller to determine a value of a business. Any questions? All right. So, how do you go about getting a income statement from a buyer? I'm sorry, from a seller. I'm sorry. So, confidentiality agreements. All right. AREA Form 560 is a confidentiality agreement. There's a lot of sellers out there that don't want to give out the information. I make $1 million. Well, wait a second. What is it? Is that your taxable income? Is that your net operating income? Is that your gross revenue? Or is that your gross profit, or is that your revenue? Which one of the 4 is it, right? Is it your revenue, gross profit, net operating income, or taxable income? Which one is it? I need to see, all right? You need to see it. You just simply can't believe what a seller is telling you what they make. You know why? It's a waste of time, because the buyer wants to see it, guys. They're not going to buy a business without seeing an income statement. It's as simple as that. And a confidentiality agreement is an agreement that can be done between you and the seller, that you are only going to share this information with prospective buyers. And before you send the income statement to a prospective buyer, Mr. Seller, I will have the buyer sign a confidentiality agreement as well. Okay? Confidentiality agreements in the province of Ontario are very, very, very strict, and they are upheld by the courts in the province of Ontario. I don't know about other provinces. In other words, if you take this information, Mr. Agent, and it says on here that you will only share it with other buyers once you get a confidentiality agreement from that buyer, and you don't bother getting a confidentiality agreement from the buyer, and the seller finds out, they can take you to court and you will lose. Okay? They are really, really, really strict documents. All right? Don't fool around with confidentiality agreements. They are legal, binding documents. All right? Be careful. All right? Don't go chatting about the value of a business, the net operating income of a business, with a prospective buyer. Oh, the net operating income's, $1 million. Oh my goodness. You needed to have a confidentiality agreement signed first before you go chatting your head off to a prospective buyer about the actual numbers. Okay, be careful. All right. The AREA form is a really great form to use. The disadvantage of the AREA form, it's a one-to-one thing. That didn't sound very good, did it? It is a person-to-person or business-to-person or business-to-realtor. It's basically one entity to another entity, okay? We also have an in-house confidentiality agreement that everybody signs off on it at the same time. The buyer, the seller, the cooperating brokerage, if there is one, and the listing brokerage all sign it at the same time. If you need that kind of a document, you can ask me for it. I don't have an example for it here because I think it's 5 pages long. And so it's a very strict confidentiality agreement. But it eliminates the need of doing maybe 4 or 5 of these forms to be able to disseminate the income statement amongst a whole bunch of people. It does it all in one shot. And so we have that available for you as well as a confidentiality agreement. Some sellers have their own confidentiality agreements that their lawyers have drawn up. I would certainly suggest to you that if you ever run into another confidentiality agreement, in other words, not the AREA form and not our form, that you run it by either Isabel or myself to have a review to see what it says, to make sure that you're not signing something that is incorrect, I guess is the right way to put it. Which brings us to, of course, are you reading your documents before you sign it? You know, I had an agent yesterday who asked me to review a 56-page document. I said no. All right, I had a lawyer saying, go to a lawyer and have this. My job is not to review 56-page documents. And so do have a read if you can. If we're not sure, Isabel or I would say we're not sure, your buyer before they sign it should take it to a lawyer. All right, it's not our job to try to disseminate what a huge document might say or a complicated legal document might say. Okay. How do you know that the seller has not lied about the numbers that they have given you? You can't know 100% for sure. The income statement that's given always has who it has prepared by, who it has been prepared by. All right. And so you can check to see if, is that person, online? Can you call them and ask, right? That kind of thing. There's unaudited and there are audited statements, all right? An unaudited statement means that the information that has been given to the accountant or bookkeeper is just basically, they call it the old shoebox. The shoebox is full of bills, and here you go, Mr. Accountant, here it is, that's what's going on, all right? The accountant really doesn't know if all the receipts for gas are applicable to real estate, as an example, or applicable to that business. In the case of a restaurant, is the restaurant owner buying food that they are eating themselves? Probably. Does the accountant or bookkeeper know that? Probably not. But the bill is there. It's an unaudited statement, all right? Unaudited statements probably make up, I'm going to take a bit of a guess here, but unaudited statements probably make up, 90% of all the, maybe even higher, 95% of all the statements that you will encounter, Meta, that the accountant has taken basically the word of the business owner, that this stuff that I'm telling you is true, okay? The revenue is probably true. The accountant probably wants to see the bank statements on what's being put in. In the case of a restaurant, they probably want to see the cash tapes, that they've taken in. The bank statements show the debit and credit card stuff that they've taken in, debit card and credit card stuff that they've taken in. It's pretty hard to hide the revenue from them, but you can throw in all sorts of expenses that aren't valid, for sure. Absolutely, you can. Audited statements are the accountant now has looked at that gas receipt, has said to the business owner, why do we have this gas receipt? Why do we have this food bill? Why do we have this much on Coca-Cola? Why do we have a car expense when you're running a restaurant? Why do we have a cell phone bill when I know, you're using that, your daughter uses that cell phone? And they go through every single slip of paper and they audit everything. The difference, so that the difference, I had my own businesses for years. I had unaudited statements every time from my accountant, and they cost me, I think it was about $2,000 or $3,000 a year for the accountant to put them together. He told me, and this is a few years ago now, so I'm not sure what they would be charging today, but he told me an audited statement would be about $15,000 because of the amount of time for them to go through every single slip of information that they have been given to make sure they're verifiable and true expenses. And so the bottom line is, does the bank believe it? right? That is your safety net. Does the bank believe it? If the bank believes it, doesn't matter if it's audited or unaudited. If the bank believes it, my goodness, you are good to go. If a buyer wants to do some sort of forensics into an unaudited statement, there's conditions for that. And we talk a lot about conditions in numbers 3 and 4, I believe it is, or maybe even number 5. In weeks 3, 4, or 5, we talk a lot about conditions to put into an offer to kind of protect a buyer from that kind of thing. But in general, as long as you kind of got a kind of half reputable bookkeeper or accountant, an unaudited statement is 95% of what you're going to see. So the cash business. Oh, love a cash business. Don't we all love cash? Oh, I love it. The advantage to a seller, you don't pay tax. God is wonderful. If you're an owner and you got cash, wow, fantastic. Don't have to pay tax. Great stuff. However, there's a huge disadvantage, and that's to make an income statement look bad. Why does it make an income statement look bad? Because you don't have as much revenue as actually you're taking in. Quite simply, the buyer disadvantage. Is the seller telling the truth? Oh, I know my income statement shows that I make $10,000 a year, but I take in $50,000 a year cash. Wow. Is the seller telling the truth here? I mean, seriously, how do you possibly know if the seller is telling the truth? The buyer disadvantage. A buyer disadvantage is that you can only borrow money based on the income statement, you guys. A bank is never going to believe in a million years that the seller's taking in $50,000 cash. The bank is not going to believe in a million years that the seller is taking in 1 cent in cash. They are only going to lend money on the income statement. It's as simple as that. How do you think a buyer is going to look at that? Cash business. What do you think? Anybody has a comment? Hard to buy, isn't it? It's hard to buy a business that shows $5,000. They're asking $150,000 for this business, but their income only shows $5,000. Does that make sense to anybody? Oh no, it's okay. It's a restaurant business. We make $20,000 cash, so my income is $25,000. Well, wait a sec. Prove it to me. Now, there are clauses, conditions that you can put into an offer. An easy condition to put into an offer is that this offer is conditional for maybe 3 weeks, maybe a month, that the buyer can sit in the business with the seller, and let's see how much cash you're actually taking in here. But that still is not going to help if they need to borrow money from a bank. If it's a cash buyer, that'll help, okay? And we talk about those kind of clauses in another week or two. I can't remember exactly where it is. I'm just checking the chats here. Great, good, Tina, thank you. So be aware, the cash business is tough, and people overvalue their business, and they have no proof. And that's why when you go onto the Toronto Real Estate Board and you look up restaurants, there's a lot of restaurants for sale. Well, I'm just thinking COVID. Yeah, there's a lot of restaurants for sale because of COVID, obviously. Let's go pre-COVID here. And even pre-COVID, there was a lot of restaurants for sale. Why? Because they're cash business. They have income statements that stink. And any buyer looking at it goes, well, you make no money. Prove it to me. Now, some restaurants sell with that condition in it. There's no question about it. I have not seen too many deals for restaurants that sell without that condition in it, and it has a terrible income statement. I get questions, I did, not in COVID. I did get questions all the time where agents would come to me with an income statement, and it was lousy. Okay, and they're asking $100,000 for the sale. Then 2 or 3 months later, the same agent has come to me and said, guess how much it sold for? No, how much? It sold for $35,000. They were asking $100,000. Why? because they don't have any support for the numbers. So when you're talking to a seller about this kind of thing, you need to determine what are you talking about? Back to the four things. Is it revenue? Is it gross profit? Is it net operating income? Or is it taxable income? We can't believe that when somebody says, oh, I make $50,000 cash, so what? Big deal. Okay? Unless you can somehow prove it, or somehow the buyer themselves can satisfy themselves about it, don't bother listing it, you guys. It's a waste of time. Total waste of time. The bottom line here is this one. Can only borrow money based on the income statement. How do you determine the value of a business? Buyer wants to know, seller wants to know. And is the capitalization rate, the cap rate, okay? Here's where a lot of people go wrong with the capitalization rate. The capitalization rate is a measure of risk. I cannot drill that into your heads more than it is a measure of risk. It does not represent an income, and it certainly does not represent a guaranteed income, not even remotely close to a guaranteed income. A capitalization rate is a percentage, okay? And it is a percentage return, okay, that a business should make, a percentage return on the income. I'm sorry, on the cost, blah, blah, blah. It is a percentage rate on the value of the business that it should make year in, year out, okay? So I love it when a buyer comes to me and says, I want to have a capitalization rate of 15%, okay? Because the buyer thinks that that is the return that they are going to get, okay? They're with a 15% return, fantastic. But what does that really mean? That 15% return is a measure of risk. Let's talk about the same business on both sides of a street, okay? Talking about a gas station now. You have a gas station on one side of the street, and you have a gas station on the other side of the street, okay? Gas stations, you think, are all making the same amount of money, you know, $1.03 a liter, 99 cents a liter, all that kind of stuff. The gas station on one side of the street is on the way home for commuters. The gas station on the other side of the street is used for commuters on their way to work, okay? Which gas station makes more money? Anybody want to take a guess? The first one, absolutely, because people driving home have an opportunity to stop to pick up gas, where people going to work generally don't, right? So which business is worth more money? The first one is worth more money. Why? Because their capitalization rate will be lower, okay? The bad news is that the first one makes more money, but it sells for more. The value of that business is more. So an investor can look at the opportunity cost of the two different investment vehicles. The business, the gas station going to work, the opportunity cost is you will spend less money buying that business, but you will probably make less money, okay? The other side of the coin is I can spend more money, buy the business on the commuter side, on the going home side. It'll cost me more money to get, but my risk is lower because it probably has a higher guaranteed income, okay? So the cap rate is inversely proportional to the value of the business. I know, inversely proportional. Boy, we thought we were talking real estate here. We're talking finances now. Capitalization rate. Here we go, okay? If a cap rate is, if the net operating income divided by the cap rate of 10%, your value of your business is $1 million. If the net operating income is $100,000 and the cap rate is 14%, your business is only worth $714,000. If you have an NOI of $100,000 and your cap rate is 5%, your business is worth $2 million. If the cap rate is lower, the business is worth more. As the cap rate goes up, the business is worth less. Why? Because a 14% return on your investment is riskier than a 5% return on your investment. Simple as that. If there's a government, let me put it this way to you. In Canada, you can buy a government bond for about 4%, maybe 3.5%. I don't even remember. I haven't looked at it a while, but let's just say 4% for a government bond. I can go today and buy a government bond in Argentina, and they'll pay me 30% return. Which one do you think is riskier? I think the Argentina one is a little bit riskier because of all the political turmoil there. It's because they've defaulted on government bonds before, that their oil business is the most corrupt oil business on their offshore oil rigs in Argentina, probably the most corrupt oil business in the world in terms of an actual business. And I can get a return of 30%. They need to sell government bonds at 30% to try to get money into their government. That's how governments raise money. They have taxes, but they sell bonds, right? And so when the Canadian government is right now pouring billions of dollars into our economy, how do you think they get that money? They are borrowing that money. All right, people are investing in the Canadian government every single second today. And we are building up, and you hear it in the news, we are building up our debt. Well, that's because they borrowed that money. Sometimes they borrowed it against ourselves, unfortunately, but there's all sorts of investors out there, folks, that are pouring money into the Canadian economy right now, the Canadian government, and the government is pouring it into our economy. And they're getting returns of 4% or 5% because we are viewed as a non-risky country. All right. If we were Argentina, it would be 30% to try to get an investor. Please give me $1. I'm praying to you. Please give me $1. And they put up the value, they put up the cap rate, and that's what happens. It's a measure of risk. And I can't drill it into you enough. If somebody comes up to you and says, I want a return of 15%, sure. Do you understand the risks involved of buying the gas station in the middle of nowhere? So if somebody is telling you that their business is worth $1 million, all right, then you can figure out the cap rate. You should be able to figure out what the NOI is. So if you're doing $1 million value and the cap rate's 10%, okay, for that particular business, and their NOI is only $50,000, you know there's something wrong. Right? So this is all just straight math, right? You're just dividing, multiplying. It's just basic grade 2 math here to figure this stuff out. If you people who are on here want to really dig into this a little bit, I suggest take a picture of it with your phone right now so that you have it. Okay, this will be recorded and put on the YouTube channel, so you can review it if you want, but take a picture of it, because everything that we've just talked about, from opportunity cost to income statements to the cash business to capitalization rates, this is it. This is how you can figure out what the value of a business is. And the key to it all is net operating income. So before we move on from here, where do you find capitalization rates? Okay, there are paid subscriptions for capitalization rates that you can get online, but there's also a few free ones as well. Some of them you have to register, and you just put in your name and your email address. And then when you get the first email from them, because you don't want to be inundated with emails from them, you simply click unsubscribe. Okay, and it's not that they are trying to promote or sell anything, but for an example, CBRE okay, which is one of the companies that you can look up. I'm giving you a hint for your homework here. CBRE, I think you have to register for them. And what they do is they send you monthly newsletters on what's happening in the economy. It's not a bad thing to read if you want to learn about commercial, but I leave it up to you. If you do subscribe to one of those, you will get your first email, and you can unsubscribe if you want to, and then you don't hear from them again. So I leave it up to you, okay? Every week, folks, we have homework. Homework, if you're going to do the homework, and I know, it's homework, and I'm not going to slap you on your wrist if you don't do it. We're all adults here, but I certainly suggest you do it. But if you want me to critique it, give you suggestions, or help you with your homework at all, I need to have it by next Wednesday. I need a day or two to be able to get it in before the next session, which is next Friday. So please email it to me. And here's your homework. Write in your own words the definition of a capitalization rate. I've been doing this course now for 3 years, and I'm tired of seeing copy and pasted definitions of capitalization rate. Write it out yourself so that you're really good at a handle on it. The second question is, find 2 companies online that display cap rates for Toronto. Find the cap rates for low-rise apartments, Class B offices, and Class A industrial. Write a short paragraph explaining why the rates may differ between the 2 companies for each segment. So what I'm saying here is that there's a bunch of companies that you can find cap rates on online. You have to Google capitalization rates, and you will see, for example, for low-rise apartments, that 2 different companies that determine cap rates come up with 2 different cap rates. And I want to get you guys to think about why that is. And then in your own words, describe why there is a range given in all caps. Would you use the low or high end of these ranges, and why? Okay, so a bit of homework for you folks. If I don't get any, it's up to you. Do it if you want to do it. I recommend you do it, of course. I leave it up to you. If you are going to send me the answers, there's my email address. I think a lot of you know it already. All right, folks, have a great day. Have a great weekend. According to Tina, tomorrow is a beautiful day. And so enjoy some great fall weather out there. It looks like a great weekend to explore some nice fall colors. So enjoy, have a great day and a nice weekend. And I hope you all join me again next week, Friday. Have a great day.